Welcome to Market Architect Capital Research, a channel focused on structural market regimes, balance sheet behavior, and institutional-grade macro frameworks. Swartz, you're looking at a market that just did something most participants will misread. The price of gold and silver moved sharply lower. Strategic capital did not follow. Gold is trading roughly 11 to 12% below its January peak. Silver is down on the order of a third from its extremes. Yet long-duration allocators, central banks, ETF buyers, and mining equity investors kept adding exposure through that move. That is the core dislocation. Price signals, correction. Balance sheets do not confirm it. In this session, we are going to treat the recent crash not as a story about volatility, but as a live test of the current precious metals regime. The objective is simple. Map what kind of force is strong enough that 7 margin hikes, historic intraday declines, and elevated volatility still fail to shake it out of the system. Pause on that. When price and strategic allocation diverge this far, the signal moves away from the chart and into the plumbing. What actually needs? Explaining. The puzzle is not that gold and silver fell. That can happen on positioning, funding stress, or macro repricing. The puzzle is that into and around that move you had CME migrating to a percentage-based margin framework, and then raising margins multiple times across gold and silver futures, one of the sharpest one-day sell-offs in gold since the early 1980s, and a record drawdown in silver, and, simultaneously, continued structural accumulation by entities that do not mark risk on a daily P&L cycle, central banks and large ETF allocators. So the question for a serious allocator is not, why did the price drop? The question is, why did the holders with the longest time horizons choose not to exit? That is the discrepancy we will unpack. We will move through the system mechanics, identify the underlying structural force, and then frame what kind of regime this behavior points to. This is not about a trading call. It is about a structural read. How the liquidation was engineered. Let's start inside the clock. This was not an organic, slow-motion de-risking. The sequence ran through the funding and collateral mechanics of the futures complex. First, the margin architecture. From late December into early February, CME raised margin requirements on precious metals several times. Initially, these were discrete hikes in maintenance and initial margins, responding to the vertical move in late 2025 and early 2026. Then, on January 13, the exchange did something more structural. It shifted from fixed dollar margin to a percentage of contract value system for gold, silver, and other metals. That matters. Under a fixed dollar regime, higher prices do not automatically increase required collateral. Under a percentage regime, each uptick in price expands the margin call mechanically. As notional values expand, balance sheets are forced to post more collateral, even if leverage ratios stay constant. This is the first mechanical link. Trend plus volatility now feeds directly into funding stress. Second, the timing and liquidity. Key hikes and effective dates aligned with periods. When U.S. markets were closing and Asian sessions were picking up, that is when liquidity is more fragmented, and balance sheet capacity from Western dealers is thinner. If you raise margins into that window, you increase the probability of forced selling, reduce the probability that natural liquidity absorbs it cleanly, amplify the distance between where the last trade was and where the next bid appears. It is not about intent. It is about structure. Funding changes into thin liquidity tend to produce discontinuous outcomes. Third, the clearing and inventory side. On the COMEX silver complex, registered inventory sits in the rough ballpark of 100 million ounces. Open interest for near-delivery months represents a multiple of that amount in notional exposure. Historically, most contracts roll or cash settle, but even a residual 5 to 10% standing for delivery implies physical demand that can converge on registered supply. If you are a clearinghouse in that environment, margin policy becomes a risk tool. You raise requirements to encourage rolls and discourage concentration into delivery. So, at the mechanical level, the crash sits at the intersection of three things: a shift to percentage-based margin that hardwires volatility into collateral usage, sequential margin hikes timed into thinner books, a physical inventory base that is small relative to notional exposure and delivery potential. Here is the structural tell. If physical supply and clearing risk were unremarkable, this degree of margin engineering would not be necessary. What was strong enough to withstand it? When repeated intervention cannot extinguish a pattern, you look for the underlying force. In this case, three structural drivers stand out: official reserve reallocation, physical tightness, and monetary regime uncertainty. First, official sector behavior. World Gold Council data shows central banks adding hundreds of tons of gold in 2025, less than the highest years, but still significantly above the pre-2022 baseline. A New Year outlook from the WGC projected that global central bank net purchases could exceed 900 tons in 2026, driven by emerging markets like India and Turkey, and by ongoing diversification away from the dollar. Surveys of central bank reserve managers show a large majority intending to maintain or increase their gold share over the next 12 months, with average target allocations inching higher. In parallel, China has reported continued additions to its official reserves into early 2026, even as prices and volatility picked up. These are not fast money flows. They are balance sheet decisions anchored in currency diversification, geopolitical hedging, and a desire to hold assets that are not another sovereign's liability. Second, physical and leasing stress. Silver lease rates spiked from typical sub-1% levels to mid to high single digits in late January. Elevated lease rates in the face of a price decline do not signal weak demand. They signal scarcity in available metal for borrowing and lending. Combine that with compressed inventories and elevated delivery interest, and you get an environment where derivatives can push the price around, but securing physical supply becomes increasingly costly. The stress indicator here is not the price, it's the availability. Third, the dollar and monetary credibility. The DXY index has been trading around the 97 area, testing a 96 to 97 support zone that technical analysts have flagged as critical. This drawdown comes after a period where U.S. real yields and policy rates look structurally supportive for the dollar, but where fiscal trajectories and political uncertainty have become more prominent. Reports and commentary around the early 2026 policy environment show markets trying to reconcile a Fed that is closer to eventual cuts than hikes, a fiscal stance that remains expansionary, and a political process around Fed leadership that introduces perceived noise into the concept of monetary independence. These are the conditions under which reserve managers tend to accelerate diversification at the margin, not slow it down. So the force that withstood the crash is not just gold bugs buying the dip. It is a combination of central banks reweighting reserves. Industrial and investment users are facing real physical constraints, especially in silver, and large allocators responding to a dollar and policy architecture that looks less stable at the edges than it did 5 years ago. Is this cyclical or structural? Now the regime question. Is this simply another boom-bust cycle, or are we watching the rules of the game evolve? Start with interventions. CME has already shown willingness to repeatedly adjust margin levels, and, more importantly, to keep them elevated once volatility appears. Once an exchange hardwires percentage-based margins and higher collateral norms into its risk framework, it rarely rushes to normalize them. That locks in a regime where leveraged players are more fragile to volatility, and unlevered or lightly levered holders have relatively more influence over medium-term price formation. That is a regime feature, not a short-term anomaly. Next, compare this episode with 2020. During the March 2020 liquidity event, gold sold off with risk assets. Central banks turned net sellers in at least 1 month, as some emerging markets liquidated gold to raise dollars. Full-year net buying fell relative to trend. In the 2025 to 2026 sequence, the pattern is inverted. Central banks remained net buyers into elevated prices. ETF flows into gold, and mining equities were positive over the month. That contained the sharpest drawdown. Outflows were regionally specific. Europe saw more profit-taking, while North American and Asian flows helped offset that. That behavior looks less like panic and more like ongoing reallocation. Then dealer behavior. Positioning data show that hedge funds and other speculators cut longs into the sell-off. That is expected. More interesting is the evidence that commercial shorts, typically bullion banks and producers, reduced short exposure materially as prices dropped. Commercials usually add hedges on strength, cover on weakness but gradually, if they are covering more aggressively, and hesitating to re-short at lower prices. It suggests discomfort with the risk-reward of being structurally short in an environment of tight inventories and evolving regulation. That is a regime tell. The entities closest to the physical market and the balance sheet constraints are not leaning into the downside with conviction. Taken together, these behaviors point toward a structural regime where derivatives and margin policy still drive acute volatility, but the direction and persistence of allocation are being set by long-horizon balance sheets and physical availability. In that kind of regime, corrections can be sharp. They do not automatically reset the structural story. Where does stress go next? Instead of asking what happens to price, it is more useful to ask, where does the pressure migrate if this pattern continues? First axis, the link between futures and physical. If registered inventory remains tight relative to potential delivery demand, and if leasing markets stay stressed, clearinghouses and large intermediaries have limited choices. Keep incentivizing roll and cash settlement via margin and basis. Source additional metal, which becomes harder under tight conditions. Or, in a more constrained scenario, lean more heavily on cash settlement conventions and contract design. None of this has to show up as a headline event. It can surface as a higher and more persistent share of contracts not going to physical delivery, incremental tweaks to contract specs and eligible bars, or a growing gap between derivative prices, and bilateral physical deals in certain hubs. The risk topology here is simple. The more the system relies on financial engineering to avoid stressing physical settlement, the more sensitive it becomes to any shock that constrains that engineering. Second axis, dealer balance sheets. Basel III NSFR rules alter the funding treatment of unallocated metal positions relative to fully allocated holdings, as these rules phase in across Europe, and later in the UK and US. It becomes more expensive in funding terms to carry large, maturity-mismatched metal exposures. If bullion banks conclude that short positions and some forms of intermediation no longer compensate adequately for the capital and funding they consume, they will shrink those books. That does not mean the market stops. It means liquidity looks ample in quiet regimes, then thins faster when volatility appears because dealers step back earlier. Stress, in that case, migrates from constant wide spreads to occasional air pockets. Third axis, the dollar and cross-asset hedging. If DXY continues to spend time near the lower end of multi-year ranges, and if the policy mix, rates, fiscal, and geopolitics, keeps reserve managers uneasy, you get a world where gold is increasingly treated as structural collateral and reserve. Other assets, including high-quality sovereign bonds, share some of that role, but with more policy risk attached. The adjustment here would not be a single dramatic rotation. It would be a slow, path-dependent shift in how much structural protection portfolios demand against currency and sovereign risk. In all three dimensions, the common pattern is this: when a constraint persists, The system does not adjust linearly. It searches for the weakest tolerance, whether that is settlement norms, dealer balance sheets, or currency credibility. How to watch this, not trade it. The value here is not a call. It is a lens. First lens. Watch allocation, not just price. When you see a double-digit drawdown in gold from its highs, but central bank net buying remains positive. ETF flows remain net inflows over the month. And mining equity exposure is being accumulated, not liquidated. That is not congruent with a classic topping pattern. It is consistent with structural capital-absorbing volatility. This is the signal. Price is the headline. Flows and reserves are the regime. Second lens. Track availability, not just cost. Lease rates, registered inventories, and delivery statistics tell you more about structural stress than the front-month price. Indicators to watch. Silver and gold lease rates relative to their historical ranges. Registered inventory levels against open interest in the first notice days. The proportion of contracts electing physical versus rolling. When prices fall and lease rates stay elevated, or when deliveries remain strong into a non-major contract month, that is a structural tell that the constraint is in supply, not just in sentiment. Third lens. Follow the rule changes and the plumbing. Margin methodology changes, new collateral schedules, NSFR implementation milestones. These look technical, but they are the operating system. Key items. Further adjustments by CME or other exchanges to margin levels and models on metals contracts. Any changes to how contracts can be settled or to the eligible delivery criteria. Regulatory guidance on funding treatment for unallocated versus allocated metal positions. Each change in isolation is a risk management tweak, viewed as a sequence. They tell you how the system is adapting to persistent constraints. The anchor here is simple. The stress indicator is not daily volatility. It is the number and direction of rule changes required to keep the system functioning. Closing orientation, information advantage in this regime. To recap, the recent crash in gold and silver is best understood as a stress test of a leveraged derivative system, sitting on top of a constrained physical base, in a world where structural balance sheets are still reallocating toward metal. You have exchanges that have raised and restructured margins, making leverage more fragile. Physical and leasing data that point to availability as a key constraint, especially in silver. And official and institutional capital that has so far chosen to accumulate through volatility rather than exit. The practical information advantage is not in predicting the next move. It is in knowing where the structural forces sit and which indicators actually carry regime information. If you want to stay close to that structural layer, focus on reserve behavior, not just rates, availability, not just price, and rule changes, not just narratives. For deeper written breakdowns of these regime dynamics and how they connect into broader macro and trading system architecture, you can find extended research and frameworks under Market Architect Capital Research on Substack. The goal there is the same as here: reduce noise, surface structure, and treat markets as systems, not stories. This is not about being louder than the consensus. It is about being closer to the plumbing.